Mary.
Are you there?
I'm here.
All
Are
right.
you there?
Oh my gosh, we're together. I have to tell you, there's actually an update on that thing I was telling you about earlier. That
What's that?
I was telling you about the Texas Stock Exchange and that they registered a special stock exchange in Texas.
Yes.
Just a couple of days ago, Intercontinental Exchange announced that it's hit 100 listings already, which is amazing. They just approved the Texas Stock Exchange, and I also didn't realize this, but there's one for NASDAQ as well.
Oh
That
my,
if
my,
they
my.
Texas, yeah, they're responding to this whole situation about having to have DEI on the board that Texas wanted to have, like the anti-woke exchange. And
Yes,
so anyway,
yes.
I was just amazed to see that news this morning. And I don't know, did I tell you what they're calling it?
No,
Y'all
I can
Street.
only imagine.
Y'all Street. Get it? Like Wall
Oh
Street, Y'all
no.
Street. I know.
Oh no.
That is too funny. That is too funny. Oh. Yes, that is too funny. But ladies, we are live.
It is time. Oh, are we?
Oh, we
people
are.
Here. Okay. All right.
Hello.
Let us begin. Welcome to our show. I guess we should probably introduce ourselves. This is our new show. We're going to do it once a quarter. It's called Compliance Unplugged with Mary and Laura, because we are going to make it normal human speak about what's going on with the SEC. And as you can already tell, we're very casual speakers, and we don't need to talk in fancy words. So, Laura, why don't you tell them a little bit about your background?
I will. Hi, I'm Laura Flanagan, and I'm the CEO of 3ICO, which is a regulatory compliance consulting firm in the New York, Philadelphia area. But we are nationwide. I am also an attorney affiliated with Royer Cooper Cohen Braunfeld, and I, like my esteemed colleague, have a PhD. Different subjects, yes, but we're both. Mary?
I'm going to ask you what it is in. Anyway, so yes, I too, I'm Mary Kopczynski. I have a law degree and a PhD, but I'm an entrepreneur. So as immediately as I got the law degree, I retired so that I could do the crazy things that I do. But my first company, we do regulatory crisis management on Wall Street. And the claim to fame as the founders of our current company, which is called RegAlytics, is we all met writing the living will for Credit Suisse, which is ironic because the living will was where you had to build out a plan if you were going to go under, how you wouldn't cause global financial contagion like the 2008 crisis. And obviously Credit Suisse is no more. But we didn't have another financial crisis, so I think we did okay. But we started a company where we gather all of the world's regulatory alerts, way beyond the SEC. The SEC is around the world, but also in other industries like pharma and healthcare and education and you name it. But we tend to feed into artificial intelligence systems that are building out kind of the new world of compliance. So we're excited for our show today. We have a special guest. You want to tell everybody who's coming on later?
Absolutely. We have Mark Shaffer, who is also a colleague, a partner at Royer Cooper Cohen Braunfeld, an attorney who has vast experience in financial services, but particularly in regulatory matters, and he is going to give us some enforcement action information that we're all going to be excited to hear about.
I love that. And so for those of you who are listening, you can go in the chat and you can call in your friends if you have some colleagues that you think are going to want to hear this. We are going to do it once a quarter. The idea behind it is it's like a lot of people think, oh, this new administration, we don't have to worry about compliance anymore, but that's actually not true. So the vision of our show was like, okay, what remains, rising from the ashes of this situation we're in, like what do you still need to focus on for compliance? So if you have any colleagues that you think should join us now, you can @ them in the comments. Also, this is live, so you can ask us live questions if you want. And, John is going to interrupt us here and there as he sees some good ones. And finally, if any of you think you would like to be a speaker on the show, reach out to us. We would love to hear from you. We particularly love, especially if any of you are regulators, right? Because those are not always easy, or maybe former regulators, if you have like a little insight on what they're thinking. So I'm going to go ahead and get started on just kind of where we are really quickly. And I'm going to share my screen. So I hope this works. It's the first time I've done it. So I go into RegAlytics, and I have a special feed called Compliance Unplugged, where I'm just looking at literally everything from the SEC and only the SEC, and then I can limit it down here to enforcement. And then what I've been able to do is I download it into Microsoft Excel, and that's where I perform some of my just personal analysis. And this is what I found out. So I dumped every single enforcement action for the SEC in here.
It's such a cool tool, Mary. It's so cool. I'm just throwing that out there.
If I had this to do my PhD dissertation, it would have been a lot easier. So a couple caveats. This is 24 versus 25. Obviously, like a month of these are, not quite, because the first month of 25 was still Biden. And also a lot of these actions were already in flight. So they're still kind of remnants of the Biden administration, but there's still some observable differences. So it's kind of unsurprising to all of us that there's a pretty significant drop in crypto-related stuff. It still happens. We are still seeing cases brought where there's bad stuff going on there. Pretty hefty increase on delinquent filing and unresponsiveness. I don't know if that's just the economy, that there's a lot of people that are going out of business. False reporting, inaccurate books and records, about the same. Insider trading is on par. So you do need to be watching for that, because that has been staying pretty serious. Misappropriating funds is actually a drop, which I find quite interesting. And that's where people use funding from investors for personal things, or they pay themselves too much, etc. But misleading investors is on par. And then this is probably not a surprise, is unregistered offerings, because a lot of these aggressive ones were the crypto companies, where they were just producing crypto products. So anyway, that's my kind of overall analysis. There's more to be looked at and done, but that's where we are today. So Laura, one of the fun things about us is that I'm more of like the macro person, but Laura's really on the ground dealing with exams. And so I'm curious from your end, like, what are you seeing this year in terms of
Yeah. So it's interesting, because looking at that information, it really speaks to, I think, a lot of what we've seen at 3ICO and the exams that we've been working on this year, that have just completed, that are still in process. Disclosure, conflicts of interest, those were big, still in that list. And, I think those are real focal points, certainly of what we've seen. Disclosure, whether it's from, disclosures on websites, disclosures in documents, how your ADV is pairing with what you're actually doing. And I wanted to bring this up because this is kind of a funny little aside about disclosures, because one of my exams this past year started out as like a marketing rule sweep. They were doing tons of those exams, and it was bifurcated. It was the first time I've ever seen that. They did like the first part and we finished, and then they're like, bye-bye, but also we'll be back in a month to do a regular exam. I was like, what? We're done. What are you talking about? But anyway, that's an aside. But this was interesting. So the advisor I'm speaking about has a program on his computer, on the website, that actually tracks, analytics, but it also tracks who's going to see the website. And at a certain point, he called me and he said, Laura, the SEC is all over our website, all over it, every page. I see them clicking in, clicking in, clicking in. And then all of a sudden, he's like, we're going to get an exam. So we got like a 2-week runway of, we know this is coming, prior to them coming in.
Amazing.
It was amazing. I think it's a nice little tool if you can think about doing that for yourself. Because when do you ever get when do you get a warning like that for a regulatory exam?
Yeah, I feel like that's the kind of thing, if I saw the SEC looking at one of my pages, I would really quickly send it to compliance and say,
That's what he did.
wrong. Yeah, don't even fix
He was
it.
like, look at
You
everything.
know,
And-
like,
yeah, and the thing is, there were disclosure issues that came via the website, and then there were other disclosure issues that had to do with conflicts of interest. And as I look at like the
Interesting.
list of exams that our consultants went through this year, there are disclosure issues all over the place for different reasons, and certainly conflicts, right? Because we work with a lot of private funds, and that's been a big, that was a big question mark in the air with the private fund changes, whether that was actually going to happen, and then it didn't, and all the preparation that went into it. But people are still thinking about that,
Yeah,
side
it
letters
is
and whatnot.
amazing. I'm curious what Mark thinks of all this. So should we bring him
Yes.
in and get him up on here? Let's invite Mark to join us. Mark, where are you? He's coming. Are we ready? Do we have Mark? We have Mark
We have.
joining us live.
Welcome, Mark.
I couldn't help but say hi, y'all.
Hi, y'all.
Yeah,
Just to start here.
y'all street. Yeah.
Well, thank you, Laura and Mary, for inviting me on to this inaugural episode. As Laura introduced me, just briefly, I'm a partner at Royer Cooper Cohen Braunfeld, and I've been practicing law for about 25 years. Most of it focused in the securities and broker dealer and investment advisor, private fund world. It's really good to be on this. So I think that, just to echo what Laura said, I think that disclosures are probably going to be the key. Just going forward, like just taking a little bit of a step back. We don't know exactly what this new administration is going to bring in terms of new cases, because as you mentioned, Mary, most of the cases that are being brought now began under Chairman Gensler. But I think there's some key things that Chairman Atkins and some of the other commissioners have said in their public statements that really do give a theme here. It's like early on in his administration, Chairman Atkins said that the SEC was getting back to its roots of promoting rather than stifling innovation. And I think that's an important point. Like, I think that the SEC has multiple mandates, one of which is investor protection and another of which is capital formation. And I do think that this administration is going to be focused on the capital formation. That being said, though, that doesn't mean that there's not a cop on the beat. There is a focus on retail investor fraud. They've stated that over and over again, and things that I think that the disclosure issues, I think, are going to be the key ones here, because whether they're fraudulent or non-fraudulent, like, one thing that I've always said to clients, and I just think is the securities laws are boiled down, or do what you say and say what you do.
Yeah.
And I think that's going to be a focus.
I looked at the exam priorities, and for those of you who don't know, the SEC every year puts out what they're going to focus on around this time of year. And so it's, I don't know how many pages it was. And the nice thing, it is organized. So if you're a broker dealer, you can read the broker dealer section. If you're a swap dealer, you can read the swap dealer section. And it's pretty tailored to what they're going to be looking for. But there was a couple sections that were universal. And the one that this is why I think you're spot on, Mark, on both counts, is, first of all, it said in relation to artificial intelligence, they're worried about your disclosures about it, right? Yeah. So don't claim that it's doing something magical if it's not, or don't claim that you're not using. And if you said last year, know you're using it.
No, you're using, people don't even know.
I guarantee everybody's usage of AI has changed in the last 12 months. So definitely pay attention to that. But also there's a worry about, I did hear Atkins saying in a or reading, obviously, because I read it all on RegAlytics, but he was commenting that he is worried about this reduction in IPOs. And I see we even have a LinkedIn comment. I didn't realize it, that in all of 2024, there were 694 bankruptcy filings, and already in 2025 we're at 655, and that kind of tracks a little bit with what I was showing on our statistics, that when it gets to the delinquent filing or unresponsiveness or deregistration, that those are actually noticeably going up. So I thought that was really a bit different. And I don't know, John, have we seen any other audience questions that you want to pass along to us?
Yes. So the comment was great and timely, and that was actually only as of October. And
Wow.
So this person's prediction is going to be a new record this year, and that's probably going to increase. But yeah, we had a couple of good questions. One from Rita Weinberg, consultant at with RGP. She says, looking ahead 12 to 18 months, what new area of regulation, AI, cyber, or crypto, do you predict will be the biggest challenge for CCOs to implement and manage?
That's a Laura question.
Wow.
If I ever saw one.
I think that those are all going to be on. We have to look out for all of them, but for me, it's definitely AI. And I have to believe that, because as many people don't know anything really about crypto, people know less about AI, because like we said before, they don't even know that they're using it. So I have to believe that advisors are going to have to do kind of a deep dive of the systems that they're using, and build policies and procedures around that actually make sense. Because it's so embedded in our working lives now, we don't even know. We're going to have to understand first that, and then we're going to have to address it in real time. But however, the regulators are going to have to do that too. And as we've seen in the past with the regulators, they kind of don't know how they're dealing with it yet either. So maybe we're all going to learn together. So for me, in terms of disclosure, do what you say what you do, build out those policies, and then actually do them and test them.
Yeah. I'd say that's good.
Right?
Compliance folks out there too, just generally, I know a lot of times the lawyer types feel like they're Luddites, meaning they're anti-technology, and they think, oh, I'm just a lawyer. I don't know all of this tech, but in the end, it's like, what are they saying it does? Does it do it? And what are you telling your investors, the public at large? What are you telling the regulators? And so as long as you're shepherding the communication to be accurate, you don't need to know how it works. You don't need to know how the sausage is made. You just know that you are selling sausage, and you presume it is edible for the public.
Right. Yeah, and I would just say that, like, in an administration like this, where I don't think you're going to see novel cases being brought, I think that people should really focus on the blocking and tackling of compliance. Is still compliance, right? You still have to have policies, procedures, systems, and controls reasonably designed to be complying with the laws, rules, and regulations that still exist. And all of these things still apply to AI. So I think in the absence of guidance, just understanding, rethinking, something Laura and I have talked about before, policies and procedures aren't a one size fits all, or we have policies and procedures, so we're good, right? No, because as things change, you need to make sure your policies and procedures, systems, and controls, are consistent with what's going on in the world right now. And people are using AI without knowing it, as Laura said. So everybody needs to be reevaluating what their policies and procedures are around everything all of the time.
So
That's great.
I'm curious. Well, sorry, John, we got another question. Bring it in.
Yeah, no, that's great. I think you all did a great job answering that question. And who knows, right? Because it is all novel. So this is why we're doing the show, is to kind of keep up to date as things progress. And so we hope that folks will continue to join us every quarter. We do have another question from my good buddy Frank Trotter over at Battle Bank. He asks, does the Genius Act back financial institutions into really being a CBDC issuer with delegated requirements for surveillance?
So I'm going to just flat out say no. And I'll tell you why. Because just to clarify, there's a difference between a central bank digital currency, which is like the US Treasury issuing the US dollar in the form of a cryptocurrency of some sort. And Donald Trump has made it 100% clear that the United States is absolutely not okay with central bank digital currencies at all, but it is very pro stablecoin. And in fact, there's been a couple US states that have individually said that they will never accept CBDCs or issue CBDCs or, even recognize their existence. Meanwhile, the rest of the world is very much talking about and doing all sorts of testings of having this ability to issue CBDCs. That said, the Genius Act is very, very specific to stable coins, which I admit I have repeatedly been like, why would you use a stable coin? I don't understand the difference, because it's basically just a representation of money. Right. But it's not FDIC insured. It doesn't have any of this regulatory safety. But the real truth about it is it's the speed and the rails. Because if you think about it, if you've ever tried to get a mortgage or something and you're waiting for money to transfer, it can take forever, right? Whereas stablecoins can be faster. And I know a lot of the big banks are building the rails for this. But fundamentally, no, the Genius Act is very specific to stablecoins. So hopefully it answers your question. But I do love the questions. So keep going with the audience questions. I don't know if you guys have commentary on crypto, because you do advise some crypto companies. Like, any thoughts of extra things that they should be focused on?
I'm going to leave that to Mark, who has far more expertise in crypto than I do.
Yeah.
I hate to be a broken record, but I want to focus to people like I think that it's clear that crypto is going to be a much larger thing now, and we're not going to see the cases about the unregistered securities, certainly not at the volume, or maybe not at all. At the same time, this is a financial transaction that the SEC is interested in having some role in making sure that there's no fraud to retail investors. So crypto doesn't mean the Wild West. Again, do what you say, say what you.
And that's the Genius Act is working on. The other one coming out is the Clarity Act. And that's basically identifying where the CFTC is in charge and where the SEC is in charge, but it's still pretty square. I mean, that's not yet, that's still like halfway past. And
that will be useful,
in the Senate.
That'll be very useful.
Because still it's sort of this nebulous thing.
It is.
But fundamentally, it doesn't matter what you're selling. It could be pancakes. It could be tacos. It could be, if you're lying to raise capital, you're going to get in trouble. And I was just telling, oh my gosh, I don't know if you guys heard me earlier, the one last week, a woman, her name is unforgettable, Shiloh Lucky.
It's wonderful.
Claimed to be a registered CPA, and she raised, I don't know, I think it was like $12 million in a Series A. And she spent the money on $1 million home and a destination wedding. And she told all the investors each time she would show up with her financials, and they, the first time it was $30,000 a month of recurring revenue. And then The next month it was 50, and then it was 80. And the SEC even showed how each time her lies were bolder and bolder and bolder. But when they uncovered it all, the max she ever had for monthly recurring revenue was $630, right?
Whoa.
Like, you don't need to be like a grandiose, fancy technical attorney to know that that's wrong, and we don't want that to happen. And that's why the SEC exists, to find people that are messing with our financial system. So,
but I think that's going to be an interesting, where the SEC does try to claim jurisdiction. I think they've said now that meme coins are not securities. I think that's pretty clearly their take, and I think that that's pretty much clear under the Howey test. But it will be interesting to see where the jurisdiction lies. But one other issue with crypto that I think is interesting that people need to think about, whether from a regulatory perspective or from just an investor protection perspective, is the custodying of crypto. And I think that that's going to be a really interesting area, like whether that's required that there be qualified custodians, or whether, just from my perspective, when I talk to people about investing in crypto funds, like, where are those assets?
Right.
Yeah.
Like, would you invest in a hedge fund if the guy said it was all in my Fidelity account?
Yeah.
What I find
for the audience knowing what custody is, because that's another thing I feel like it's important to break these things down. But if I give money to John to manage, and Mark gives money to John to manage, there's laws. Like, John can't just put it in his bank account and spend it freely. He needs to have a separate account for Mary and a separate account for Mark, and he needs to make sure that he's only using Mary's money for Mary's stuff and only using Mark's money for Mark's stuff. And so if you're dealing in cryptocurrencies, and do you have to custody these assets? Do you have to have a separate account for each one of those customers? And that doesn't even get us into AML KYC, which I think we should jump into now. So what are you seeing now? I know AML KYC was hot. Is it still hot? Is it less urgent?
It's cool. It's cooled. It's cooled.
Yeah.
Well, I mean, we were all getting ready. We were, 3ICO made this big push to get ready for advisors and the new requirements they were going to be subject to for AML, and then not. So,
Interesting.
So many other things.
Oh, that, like the beneficial owner rule. Yeah, we should probably bring the audience in on this. Okay, so quick backstory. You need to know who you're doing business with, right? So if somebody shows up and they aren't who they say they are, you're going to get in trouble for moving their money around the United States. And that's across the board. That's every company in America, every human in America. If your pool cleaner is taking your money and illicitly financing global terrorists around the world, like, you could get in trouble for not knowing who your customer was. And so there was a big push to find out what we call the beneficial owner. So if you have a company that's owned by a company, 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 who have the two eyes and the nose that you're doing business with? And these financial institutions need to know who are the eyes and nose, who are the beneficial owners. And there was going to be this huge push this year, and then Trump took over, and now it's not going to be enforced. So everybody was prepared for this, and now they're not. But isn't it still just good practice to know who you're doing business with?
It's a good practice, but it's also, for advisors, at least, there's, fiduciary responsibility. You're doing that kind of work anyway, just in how you're getting to know your clients, and required meetings with your clients. And, so I think it was another layer, like, FINRA focused, but now in the SEC space. And it's maybe even more, as proposed, more robust than your regular advisor might need. But so much of what they're looking at and knowing your client, they're already doing in that space.
I feel like this might be sort of, I don't know. On one hand, I could see it being welcome news, because, John, you know what it's like when you're trying to do business with someone and you have to deal with compliance, and wait for them to get through all their checks before you can start business. But at the same time, I feel like they bumped up a little bit on the suspicious activity reports and like a lot of the requirements around transaction reporting. And I think that is largely because of crypto, that they're changing around, like, when do you have to tell FinCEN and different agencies, that something's weird, somebody's moving money, that it seems suspicious and wrong. So,
but I do think the proposed new regulations were really just going to impose heightened compliance standards and reporting standards. It doesn't change the fact that this is something, again, with the fact that the SEC might be less novel, but it's still out there. Advisors still have AML requirements. They just don't have this new heightened level of certification that was going to be required. That doesn't mean that AML doesn't apply to advisors. And I think that sometimes people have taken some of this backing off on certain higher compliance standards as indicative of the fact that perhaps the laws don't apply. That's not at all true.
Right.
Yeah.
I also noticed a lot of off-channel communication. That was a very, very hot topic back in the day, which was like how and who you're talking to your customers. And, Laura and Mark, you guys are going to know the ins and outs of these, but if you're talking to someone, it needs to be tracked and recorded by the financial institution. I guess how is that showing up in exams at all? Like, is this new administration really worried about it? It is. Okay.
Absolutely. I mean, it hasn't been the focus, but it's always on like the checklist. You know what I mean? It's always on how are you archiving? Are you using texting, talking, are you talking to clients via text? And, we see across the board firms that have absolute no policies and firms that are, working with the global relays of the world to archive texting and messaging and that type of thing.
Is there a point where a firm can kind of get away with like, we're too small to worry about that?
No.
Or like, no.
No. I mean, there are state registered firms that follow state rules, but I'm from my perspective, the SEC rules are the ones to focus on, even at a state level. I mean, most of the firms I've worked with want to be SEC registered anyway. So, go in the direction that the horse is running, kind of a thing. I wouldn't play, and the rules are generally the same. They're following, the SEC for the most part. But with stuff like that,
also from the perspective of the entity, even if that's not going to be a focus of enforcement, don't you want to have control over or know what your advisors are doing or what your people are saying to their clients? Like that's an internal control that you want to have, whether or not that's likely to result in an enforcement action, just because you want to know what your employees are doing.
But it's also a supervising issue.
Right, exactly.
Critical. You could be talking to a client on your phone, private texting on your phone about investments that you haven't told the compliance department about that are outside of your firm. So there's a supervision issue here.
Yeah, I actually had a colleague.
Oh, yeah, go ahead.
Sorry. I actually had a colleague that had that happen where he worked an outside deal with a client with somebody outside of the firm and got caught and ended up getting sent from the firm. They got basically fired because of it. Even though there was no laws, there was no this or that, he didn't disclose it.
Yeah, and I'll tell you, a lot of it is, bizarrely, you don't know what you don't know, or you don't think about it. And my experience with advisors is that, a lot of times when there's a mistake made, it's not, malice. It's not, attempted fraud. It's nothing, it's more like negligence or just not knowing what you don't know. and not being conscious that you're supposed to talk to your compliance officer about it before you do it.
You know, it's interesting too, just drawing the parallels, because like I've been kind of out of it, right? Like I'm not as inside financial institutions as I used to be. But I found that the tech has come so far since, you know, the pandemic, even with Zooms and all these things, that a lot of companies, not for compliance, but they are recording every call because A, it's helpful, and B, they can actually find opportunity in their calls. Like I had someone telling me recently that they monitor their calls. This is a customer of mine that they used, I can't think of the name of the product, Gong, right? Which is like for the sales. It records your sales calls, and then you can find out what are your customers asking for. And this particular company said that regulatory content had come up like something like 50% of their phone calls, right? So it's similarly with fraud. You know, nobody actually enjoys fraud. Nobody wants fraud. So it's important to have a fraud department because you don't want to be stolen from. And it's a good time, really, I think maybe because the regulators are backing off a little bit, that you can have a little breathing room to invest in some of these new strategies and technologies. And so I'm curious what you guys have seen in terms of solutions around some of these pain points in compliance.
Wow. That's a big question, because I feel like every day I am shown some new solution to by some vendor that I've never heard of before. So I don't know how to speak to that without
so many. It's changing like every day. Like
every day. And it becomes almost like a little bit of a noisy distraction, because you need like a department to focus on the solutions to help your advisors avoid some of these pitfalls, because there are so many. And because compliance seems to be this catch-all that everybody thinks should be doing all of it, even though it's impossible to do all of it. That's why, you know, you may have a compliance department, but you're going to have all these little facets that are doing, you know, the archiving and the, you know, quarterly attestations and the, you know, because it's just, and then now with tech, with so much, you almost have to have like a department that focuses on vendors supporting the compliance program.
Yeah. One of the things that I was curious about as a former advisor, and has really been baffling to me is you know, back when I was an advisor, we had to disclose so many things, right? And if you were going to do something that was high risk, like crypto is absolutely as high a risk as you can get, and we've seen that in the volatility most recently, I just don't understand why, you know, I'm trying to understand is what is the plan for the future? Like, how are advisors supposed to disclose? How did they represent crypto? You know, where are they custodying it? And you know, not having presidential immunity, you know, what are they going to do if things really fall apart and then all of a sudden the floodgates open of customer complaints, right? Because that's what happens. People don't say a word, they're happy while things are good. As soon as things go sour is when the complaints start, you know, flying through the door. So I want to caution my advisor friends that day is coming if it hasn't already started because of the volatility we've seen recently. So just be very careful. Make sure you have limits on how much you're going to invest in it. Make sure you're disclosing all of that. Make sure you're staying in complete contact with your clients, because that's the way you avoid those issues, is by making sure they understand what they're getting into and then keeping them posted as things progress.
Yeah, and I feel like we failed terribly in explaining John, Laura, but to the rest of the audience, John is the brainchild of this show. John is a networking extraordinaire that brought the two of us together because he knew we would be fast friends, and he was 100% right, because whenever we talk, this is what Laura and I talk about for real. So he's like, You should just put this on record because people need to know what you're saying. So thank you, John, very much for bringing us together. I'm curious from Mark's perspective, what are some of the top things that you would advise people for going into 2026 to protect themselves from litigation, really, right? What do you suggest?
Not to beat a dead horse, but again, do what you say what you do. Like disclosure, I think is going to be very, very key right now in the absence of novel new causes of action. And kind of what John said, that's really just back to the blocking and tackling of compliance. If you're going to be offering risky investments, that's okay to do so, but make sure that they're suitable to the people and that you're disclosing what you're investing in, how that money's being custodied, and so forth. It's the basics of compliance and securities law disclosure, I think. So I think, and second, I do think that there's going to be a focus on recidivism, just people who, and not just recidivism, but one thing that I think is very important from the compliance perspective is when people enter into an exam, your goal is to exit the exam without any findings. That's not likely to happen. Your real goal is to take those findings and not have those to be such a level that they get referred to enforcement.
Right.
But when you have these findings, you come up with a remediation plan and you actually do the remediation. I think that when people are found to have violated something that they supposedly remediated in the last exam, that's fairly likely to let there be light.
That's a good, or at least look like you tried, because that's what I had to do a lot for Credit Suisse.
But I think it's just
in trouble, and then we'd have to, even we spent all this money and it failed, we'd have to say like, look, we tried to fix it.
Here was the plan, and then you actually have to like have a plan to do the plan. Like
do it. Yes.
Do it and have the benchmarks, the sign-offs throughout the process. Just that, I think, is the goal. The goal is to make examination findings not go to enforcement and then to actually remediate them.
Yeah, the goal is to get like a B minus, right? It doesn't have to be an A plus. You need to get a B minus, or maybe you get a C, you get an exam point, and then the next time it's a B minus. You gotta like slowly show the progress like you're a student, That's the idea.
Agreed.
Well, I do want to thank all of the audience for joining us. Like I said, we're going to do this every quarter. Next quarter is going to be fun because we're going to look through just enforcements and the stats of what really happened. But this was kind of an end of the year wrap up, looking at all of 2025 and what we're expecting in 2026. I would really like to thank Mark for joining us today. Definitely want to thank John for introducing Laura and me to each other, because it has been so much fun finding a kindred spirit to nerd out on all of this. Does anyone have any last words? Oh, and anyone who you think would be a great participant on this show, we want to hear from you. I think that, get in here. It'll be fun.
Yeah, absolutely. And thank you for agreeing that this would be a fun, informative, valuable show for our audience. And I'm looking forward to the next episode. And both of these two are super creative. If you don't know, Laura actually produced an amazing documentary I'm going to watch tonight. I'm going to post that after I do, because I want to watch the whole thing. I've seen the trailer and it looks amazing. And so they are multi-talented women, and I'm super proud to be a part of the show with them.
I was at the premiere of that movie a year ago, and it really is amazing, and everyone needs to go. See you.
I'm not cross promoting here. Not cross promoting.
Okay, but
Thank you.
there's no
Did you just
rules.
close that, Laura?
There are no
Hello,
rules.
Laura.
Unplugged. Unplugged.
Yeah,
Yeah,
unplugged. Yeah, I love it.
Thanks,
absolutely.
guys.
All right. Thanks, everyone.
Thanks, everyone. Thanks for joining us.